How do you flip real estate, and what are some of the pitfalls that you should avoid when looking to buy a flip? Hey, my name is Eric. I'm a broker here in Denver with nearly a decade of experience. If you have any questions, my contact information is in the description. All right, now if you've watched HGTV at any point in the past 15 years, you're probably familiar with a concept of real estate investing called flipping. Now, flipping is really a version of value-add investing, meaning you're buying a property, adding value to it, and then reselling it. Now, you don't have to resell it, right? If the interest rates are a little bit better, you could do a BRRRR method, which means you refinance and rent it out. But today I'm talking about flipping, okay? So when you're flipping real estate, there's different ways that you can look at this, but they all lead to the same destination. Now, technically, if we're talking about how to analyze a deal, okay, for you to flip property, you are looking at what's called a rehab pro forma, right? So you're doing a rehab pro forma analysis. Now, if you really want the technical version of that, I have it in an Excel document. I can send it over to you if you want to see it. But for today's video, I'm going to explain this to you in more simple terms, simple terminology, and give you a couple of different frameworks that you can use to analyze deals, to know what a deal should look like if it's reasonable, okay? And then we're going to talk about pitfalls that you want to avoid, especially if you're early on in your investing career. And then lastly, what I'm going to do is I'm going to show you a project that I personally did and what the numbers looked like on that to give you an idea of what you should expect here in the Denver market. Now, Denver's market is pretty competitive when it comes to renovating and flipping homes, but there's still people who make a lot of money doing this. And in fact, you could even make quite a bit doing this part-time on the side. You could do one house every 3 months, right? So one house a quarter, that's 4 houses a year. And doing 4 houses a year, you could comfortably generate 300 to 400K every year by doing this on the side, all right? Now, the way you analyze these deals, okay, the first number that I need you to understand is called after repair value. So short for after repair value is ARV. ARV is what a project is worth when you actually sell it, all right? So this is based on comparable sales in the neighborhood of the subject property, not sales, not listings that are trying to close, not listings that are pending, not listings that have been sitting on the market or they're gonna maybe get an offer soon. These are listings that have actually closed in real life that are in the same neighborhood of the subject property. Now remember, in the state of Colorado, okay, residential real estate is valued in 3 different ways. It's location, condition, and size. However, in our state, the primary metric for size is above grade square footage. Now that doesn't mean that the basement doesn't add value. It does add value, but it's not taken into account by an appraiser the same way that the above grade square footage is, okay? So first and foremost, when we're talking about cost per square foot, we are talking about above grade square footage, not total square footage. The reason I bring that up is because one mistake a lot of rookie investors might make is they could take a property that's 1,000 square foot above in a ranch and 1,000 below in the basement. That's 2,000 square feet. And what they might do is compare it to another property that's 2,000 square feet above grade and doesn't have a basement. You don't want to do that, all right? That is not a comparable sale. Do not use properties that do not have a commensurate level of above grade square footage, okay? So, state of Colorado, property valued 3 different ways: square footage, location, and condition. Now, on the condition, if you're looking at comps, you want to find comps that are going to be similar in terms of an after repair value. So these are basically renovated homes. If you can't get one that's renovated, that's okay. You can use one that's in pretty good shape and try to adjust from there. But usually, especially in the Denver market, there's always renovated homes for you to look at in the area that you can use as a point of reference or comparison for your after repair value figure, right? Now, if you need help with finding ARV, figuring out ARV figures, you can always give me a call or send me an email. This is something I do for investors all the time. All right, so you understand what ARV is, okay? Now, the difference between the ARV, the after repair value, and what you actually purchase the property for is usually going to be at least 50% of the initial purchase price, okay? So what I mean by that is if you buy a property for $500K, you're looking to sell it for about $750 plus, okay? You need to have that 50% gross margin on the acquisition cost. Now, the reason that you need that is because you need to account for a lot of different things. You have to account for the renovation cost, okay? You got to account for the carry cost, which is the cost of financing. Unless you've got, $700K in your bank account, you're probably going to use some form of financing, so you got to account for that. And then you got to account for cost to sell, okay? Now, that's going to be a combination of commissions, title fees, and then most likely in this market, probably a few different buyer repairs or incentives or concessions that are negotiated upon the execution of the purchase contract when you actually sell the property, all right? So just to go through that real quick, when I talk about financing, usually we're talking about hard money lending. Now, you could try to do this with conventional financing. It's going to make your offer a little weaker. And a lot of times you're buying a property that's in really rough shape. So you need to have a cash offer, okay? But you don't have 700 grand in your bank account, or at least most of you don't. So what you need to do is you get a private money lender, also known as hard money, okay? That hard money lender is going to finance up to 90% of the acquisition of your actual project, right? So when you're buying the house, let's say you buy it, easy numbers here, okay? You buy it for 500K. That lender is going to loan you 450. You're probably putting 50K down, so 10%, all right? Now, on top of them giving you money, or in addition to them giving you money, it's going to come with a couple of costs, okay? The first one is going to be origination points, and depending on your lender, that could be anywhere between 0 to 3%. But usually it's 1 or 2 points origination of the acquisition cost. All right. So you buy it for 500, you might have 1% origination. So that's 5K right there. And then they're going to charge you between 10 to 13% interest. Okay. So if they're loaning you 450 at a rate of, let's say, if you get a really good deal, 10%, so that's 45K annually divided by 12 months. But most of the time with a lot of these projects, you're probably looking somewhere in the neighborhood of $4,000, $5,000, or $6,000 a month, which can go up depending on the purchase price of the property. All right. So that's called your carry cost. Okay. So you've got the price that you buy it for, you've got the carry cost, and then next you have the rehab cost. Now, here's one of the biggest mistakes that early or less experienced investors make is they try to get rehab done by general contracting companies. Now, nothing against GCs, but most of the time, most remodeling companies are going to be very expensive, all right? So just as a point of reference, most of the GCs in town, if you go to a kitchen remodeling company and you ask them for a quote to remodel your kitchen, you're probably looking at like $75,000, all right? But you could get the same thing done for 25 to 30, okay? The difference is if you hire the GC, you're paying them to supervise the job and bring in all their own subs. And what I'm telling you is that in order to be profitable, you're going to have to be the one managing the jobs. You're going to have to be the one sourcing out and getting bids from the subs. And by subs, I mean subcontractors, okay? So you're going to have a different crew for cabinets and counters. You'll have a different crew for framing and drywall. You'll have a crew that does painting. You'll have a crew or a licensed professional, right, for electric. You'll have a different licensed professional for plumbing and a different licensed professional for the HVAC, okay? So in order to be profitable, you have to source all of these subs yourself, or alternatively, get a contractor that you can negotiate a really good price with. But most people don't have access to that. So most likely, you're looking at getting your own subs. But you have to keep this remodeling budget within reason, okay? Because if you don't, you'll lose your shirt. And that's the first thing that people do. It's one of the most common reasons that people can't make money or lose money trying to flip is they can't keep control of their cost, all right? So you've got the purchase, you've got the financing, you've got the renovation cost, okay? And with the financing, you also have the carry cost, right? And then when you finish the project, you have cost to sell, okay? Now, cost to sell is going to include things like real estate commissions. It's going to include title costs. And in this market, right, it's also probably going to include either concessions for the buyer. Now, that could be either to negotiate point buy down or closing costs on their loan, or it could be, for repairs for the property. But most of the time, you might want to factor in 0.5 to 1% concessions for the buyer when you're negotiating the offer, or afterwards when you're negotiating the inspection period, which I like to call negotiation number 2 for a lot of buyers, especially in today's market. All right. So when you're looking at these numbers, okay, I already told you, you are calculating 50% between when you buy the property and when you sell it, right? So if you buy it for 500, you're selling for 750. You buy it for 600, you're trying to sell for 900. You buy it for 800, you're trying to sell it for 1.2, okay? That's generally the gross margin that you're dealing with most of the time, okay? Now here's another way to look at it. You could also look at it as you need to buy at 80% of ARV minus repairs, okay? So what do I mean by that? Well, let's say you found a really nice house, or it could be a nice house in a nice area, and after renovating it, okay, it's going to be worth $1 million. Well, if it's going to be worth $1 million, what that means is you're looking at 80% of that number, okay, which is 800K, and let's say the rehab you can get done for 150, so you're looking at buying it for about 650K, right? Because that's going to give you the margin between the after repair value, okay, 80% of that is the 800, and then your repair cost is 150. Or if your repair cost is 200, you're probably looking around the 600K range. Now, this isn't always the case because not every house that you buy is going to need that big of a remodel. But generally speaking, if you want to have a healthy margin, you want to get a good return, you are looking at homes that are going to have pushing to or above a six-figure remodeling budget, and that's with you getting your own subs, okay? So it's not as easy as it looks on TV, but it is very profitable. Now, in the thumbnail of this video, I mentioned to you that I made 160K, or I generated 160K in a 6-month period. Now, that was between 2 different flips. On those flips, I had a partner working with me, and we were pretty successful. As a matter of fact, I could have even been a little more successful. It could have been closer to 200K. However, I took too long to do the remodel. Reason why is because I had a lot of clients I was working with at the time, and that's always a priority number 1 for me. And flipping is always a secondary priority, or sort of a part-time thing, with being a broker as my number 1 priority. So just to give you some concept here, or give you a reference of what these numbers look like, I'm going to go through this project that I did so that you can see what a before and after looks like, and I'll give you an idea on numbers as well. All right? All right, so here's an example of a project that I did here in Park Hill. This was a mid-century style home. I bought this property, as you can see here, for $590. Did some really cool things to it on the outside and on the inside, and I sold it for $852,500. As you can see here, the original property, the inside was pretty closed off, kind of this closed off living room feeling, and then over here in the kitchen, galley kitchen with a wall here. What we did was we changed the outside, cedar, soffit, and new fascia, all new windows, new paint. Oops. And this property on the inside, we opened it up. So much more open concept living room, and then took out the wall and the kitchen, had an open concept kitchen as well. The reason why I'm showing this to you is to give you an idea of what these numbers can look like in real life. As you'll recall, I told you that you should be aiming to get a 50% gross margin from the price you buy it for and the price you sell it for. And then I told you should be looking at buying at 80% of ARV minus repairs. Now, my numbers here don't really fit into that exactly, right? And that's what I wanted to show you. So I bought this for $590, okay? If I had budgeted a 100K remodeling budget, I would have been buying it at 80% of 850 minus 100, which is 580. So based on the ARV minus repairs, I bought it 10K over that number. If I had aimed to get a 50% gross margin on the purchase price, okay, I would have sold this for 885, not 852.5. So these numbers aren't always exact, but it should be a framework for you to work from. This is what you should aim to get. You're not always going to get it, and at the time, this was a pretty competitive market, so this is just the reality of the market at the time. And at the end of the day, it was still a profitable project and came out really well. But that's why I'm showing you this is more of a framework or more of a guideline. You don't always have to be within these parameters, but it helps to aim for it. All right, so this is an example of what this actually looks like in practice. If you have any questions, let me know, and I'll see you next time. Bye.